And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. Between yesterday and today, but people are trading stocks today as if they weren't collapsing because they're looking at the CPI from last quarter. So, and the other thing that they're doing, they're saying, oh, with today's CPI, that means there's going to be a rate cut. No, it doesn't, not at all. See, the 2-year is collapsing because traders think the economy might be weak, not because inflation's fixed. So that's a fear cut. Banks, and we all know, hate fear cuts. So today's good earnings from a quarter back are masking the fact that the yield curve is steepening, which means it's supposed to be getting better, for the wrong reasons. So as I told my members, sell into the rally, sell into these banks. They're all going up for the wrong reason. So, I mean, it's just, it's the old story of trading. You've got to follow the money. Stop listening to the jibber jabbers. So anybody who bought banks today should be selling into the banks, not buying and holding them. So again, they got lucky today. They could tell a story today to get the banks going up. And on last quarter's numbers. So sell into that rally, and we'll take a look at some of the banks here just to see. I mean, it's just amazing how they get away with this stuff. No wonder 85% of traders in the United States lose money. You wonder why? Okay, so, I mean, it's good to know last quarter's numbers, but you also got to remember the market looks forward, not in the rear. So today, traders were looking in the rear and then saying, oh, there's going to be a rate cut from the information they saw in the rear. We got a whole different deal right now. So they got lucky. So again, when we went from 4.27 to 4.18 since yesterday, both those numbers are masking the fact that the yield curve is steepening. And again, for the wrong reason. So let's take a look at the banks. So JP Morgan. JP Morgan on that news this morning on their numbers gapped up, okay? And it's pulled back a little bit, but still holding, but it fades a little bit. You got to also be careful because these are machines pushing these numbers, not our institution. So you'll get so they'll fade these numbers back. That's what happens when you got the machines. Citi, here's a good example. Citi went up this morning, okay? And you take a look at Citi. Here, wait a minute. Let me just put up JP Morgan for contribution. Yeah, it went back. Citi, when it shot up this morning, it not only gave it all back, but it gave more than everything back. So we started out this morning and around, I don't think it was around maybe 3, I'm just guessing, I think it was around 133, something like that. And it went up towards 144 and it gave it all back. BAC, okay, that rallied this morning out of the gate because of these numbers, but then it started to pull back. Nothing serious, maybe some profit taking. And Wells Fargo went up and gave most all of it back, kept a little. So that's not a strong showing. So that's a problem that we have when you're, again, looking at the, acting today on your trades and you're looking at the old numbers or the previous numbers. Shouldn't say old numbers, previous numbers. So right now, so that's what the banks are doing, okay? And the banks, okay, watch what happens with these banks tomorrow, okay? Within the next 2 days, you'll see how they'll start pulling back. They'll all start pulling back. So again, if you look at, for example, let me give you an instance, Citigroup. Now the reason why I pulled back, look at the trend. The trend is already pulling back. I mean, the trend is down. So people jumped into these banks this morning, jumped in the city. They didn't look at the trend, and they want to know why it gave it all back, because the trend's down. See, the one thing you got to understand about trading, if you really want to be a good trader, you don't listen to any of this stuff. You follow the money. And you follow the money based on your trend. Trend's everything. Trend tells you your money's going to go in. Trend tells you your money's going to come out. You follow your yields. And if you just, again, pay attention to the yields, it'll help you a great deal, because yields tell you everything. Pay attention to IWM. So if the CPI, just so you know, so when the CPI comes in and it's hot, tech gets crushed. Banks will get a pop. If CPI comes in cool like today, tech rallies and banks weaken. But that didn't happen, did it? That didn't happen. Banks were strong, and most of our tech stocks, let's go to our major tech stocks, we call them the factory stocks, ASML, and look what happened to ASML. Same thing. It gave a lot of it back this morning. Clack rallied on the opening, then gave it back. Not all of it, but a good chunk of it. And AMAT gave most of it back after it rallied this morning. That's not supposed to be happening. CPI comes in cool, tech's supposed to rally, and bank's supposed to weaken. That's not happening, is it? Banks are rallying, and techs aren't. Now, some of the banks are pulling back. So my point is, the next time you get the CPI report, if it comes in hot, tech will get crushed. Always do, and banks will pop. If the CPI comes in cool, tech will rally and banks will weaken. And what we saw today, because people were listening to the numbers of last quarter, they interpreted a steepening yield curve, which means that's good. It just means that when you have 10-year rises faster than a 2-year, that causes the spread to widen and to move closer to the ideal 150 plus points. You got to get back to the 150 plus points. You got to get back there to get the institutions to come back into the market. And we need the institutions aren't going to come back into the market until that happens. And the Congress stops every quarter having Treasury go out and sell $500 billion to cover the money that they spent more than the income. So that's the problem we got. But also, again, the steepening yield curve, the banks went up today for the wrong reasons, because the steepening yield curve is not happening, or it is, but not for the right reasons. Now you go back to IWM. This is really helpful because, again, IWM, small mid-cap stocks, that will tell you every correction, every crash. It's never wrong. You got to follow that every day, because IWM is the real economy. Okay? IWM, that is the real economy, and not SPY or Q or the Qs. That's not the real economy. And IWM is the market's true serum and never lies. So, and IWM, again, when that's rolling over, and the spiders and the Qs or XLK are not rolling over, then that's a fake rally. So if IWM is flat and the S&P and Qs are up, that's you know, hey, this is a fake rally. And if IWM rolls over months before the spiders and the Qs, you know there's going to be a crash or a correction. And remember, IWM is always the first casualty of all these Fed mistakes, Fed policy mistakes. So everything you're hearing today okay, because of what happened this morning with earnings, you're going to see it all unwind, okay? Or I should say a high probability, I don't know, but I would say it's going to be a high probability those bank stocks are going to unwind because, again, the steepening yield curve that happened today is for the wrong reasons. So always make sure that you watch IWM and you understand when CPI is hot, what it does, when CPI is cool, what it does. And it'll make a better trader out of you. That's it for today. I will see you tomorrow, same time, same place. My podcast, philsgang.com. Check us out, free for 10 days.